Hey there, Investorholics. Welcome to another ETF Spotlight review. Today we'll be taking a look at VGE, which is the Vanguard FTSE Emerging Markets ETF. So I suppose the question is, how do you simply and cheaply invest in emerging markets? These markets can be useful for diversification, as well as offering access to some of the highest growing economies in the world. Obviously, because I look at the exchange traded funds, ETFs, and that's the way we can do it. So this one might be interesting to buy and hold investors with a long-term horizon, looking for capital growth, international diversification, and obviously anything in emerging markets, you have to have a high tolerance to risk because these things are going to be going up and down. Usually they're going up when the rest of the market's going down and going down when the rest of the market's going up. They kind of act counter-cyclical anyway. Hey there, Investorholics, it's Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content. You can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your financial life, expand your investment horizon, and crack your financial sky. Don't be afraid to give us a thumbs up and a subscribe. Okay, let's take a look at investment objective here. So a Vanguard FTSE Emerging Markets Share ETF seeks to track the returns of the FTSE Emerging Markets All Cap China A Inclusion Index. So obviously that one includes your China shares, the index, a little bit more on the index, the US fund. VWO seeks to track the investment performance of the FTSE Emerging Markets All Cap China A Inclusion Index. As we mentioned, the FTSE Emerging Markets Index is a market capitalization weighted index representing the performance of the large, mid-cap and small-cap securities located in emerging markets all around the world. The index is comprised of roughly a little over 4,000 different securities from 24 countries. So you're going to get exposure to China A, the FTSE China A All Cap Index securities is adjusted for aggregate approved qualified foreign international investors. So pretty much just tries to meet the available quotas for international investors anyway. Moving on, if you need to know a bit more about that index, always read the PDS that comes with these products before you invest. So obviously we have to have a Y factor. As I mentioned, you can get exposure to more than 4,000 companies from over 20 countries. So countries like China, Taiwan, India, Brazil. Access to long-term growth potential for some of the fastest growing economies via global brands that are listed in emerging markets. A low-cost way to invest in emerging markets, which have traditionally been difficult and expensive for Australian investors to access. So I think that's the beauty of ETFs. That makes accessing some of these more exotic markets or just markets outside Australia in general a little bit easier if you've got a specific country in mind that you think might be performing well over the next 5 to 10 years. Okay, we had a net asset value at the time of research of $65.64. It's trading above that at $66.15. Market cap of just over 600 million. Management costs of 0.48%. Not too bad, I suppose. but we may touch on some additional things here later on. Distribution frequency, so you get a dividend every 3 months. Dividend is roughly about 2.5%. So obviously, VGE gives you low cost exposure to companies listed on the emerging markets, and allow investors to participate in the long-term growth of potential good cycles in these economies. It is exposed to fluctuating values of foreign currencies, so it's not hedged, so that's something else to sort of keep in mind. VGE invests almost all of its assets in the US listed Vanguard FTSE Emerging Markets ETF, VWO, so you probably want to have a look at that one. So the Australian fund, which is VGE, is restricted under US law from holding no more than 3% of the assets in the US fund. So what happens is VGE trades futures to gain market exposure without investing directly in the US ETF. This allows Vanguard to maintain the fund's liquidity without being underinvested. Importantly, derivatives are not used to leverage the Australian fund's portfolio. So, I think the way this is set up, it's, high risk level, so potential for higher returns and obviously lower risk investments. However, there is a high potential for below average returns, and therefore, you could have some issues with capital loss. And also you need to have a longer time frame for these type of investments, 7-10 years type thing. So you want to be going through the cycles on these ones and getting the value. So it may suit buy and hold investors, as I kind of touched on in the beginning. Obviously, like I said, you've got to be looking for long-term capital growth. There's some tax-effective income, and you definitely have to have a high tolerance for risk associated with the volatility in foreign share markets. So you've got an investment that covers 24 different countries, so you're going to have a lot of inbuilt volatility. So you just have to really have a good mental attitude to hold on to these things through these cycles. I mean, the main thing to sort of keep in mind when we're doing this, investing in these type of emerging market type products, and all these sort of what I call non-core, so they're type satellite type products that I'd use as sort of a lower percentage in your portfolio. So the emerging market phase occurs when economies see their most rapid growth. So these countries, I should say, are growing fast. But that also the fast growth also creates great volatility. So that's sort of something you have to be mindful of. So investors are looking for countries where there is little political or social unrest and consistent economic growth. So I mean, the emerging markets, it's hard to find that, but I mean that's kind of the holy grail. So with this one, you'll get, as I sort of mentioned before, you get exposure to China, Taiwan, India, Brazil, Saudi Arabia, South Africa, Thailand, Mexico, Indonesia, and Malaysia. So we're looking at performance here. The Vanguard website wasn't very good for this one for some reason. There were some issues with the website or whatever with data and stuff, so I had to sort of cobble it together through a few different sources. Total return since inception on this one, looking at a bit over 5.5%. In the last year, you would have been down quite a bit, 15%. So it gives you exposure to Taiwan Semi, Tencent, Alibaba, Reliance Industries, Miatanu Class B, who the hell they are. Obviously, Taiwan Semi is listed on the New York as well, so they're using some ADRs there. Vale, which is Brazil, more China, and a couple other banks there. I think my guess is 1120. That might be the Saudi bank, one of the big Ali Rahaji Bank or whatever, however you say it. I think that might be a Saudi bank. So I suppose, summary, VGE provides low-cost exposure to companies listed on emerging markets, allowing investors to participate in long-term growth. But you also got to remember that you're exposed to fluctuations in value in foreign currencies. As like I sort of mentioned, this is an unhedged product, so that's always something to keep your sort of in the back of your mind, I should say. So despite volatility, the most growth and the highest returning stocks are going to be found in the fastest growing economies. I mean, that's why we're fishing in this water, I suppose. High risk but high return. The secret to adding growth from emerging markets to your portfolio is to limit yourself to reasonable risk. That's kind of what I sort of touched on before. These sort of investments are only ever satellite, so 5 or 10% of your overall portfolio. I suppose there are a few different emerging markets ETFs, and you need to have a look at them all. I mean, one big reason I don't like this is because pretty much all this ETF does is buy the shares of the ETF that's listed in New York, so in America. And they still charge you 0.48% management fee. So I think, for me, that's a bit rich. I think it should be, maybe 3.5 or even 3, but they do trade and do some other creative things to still generate the performance. So, I mean, maybe that's where they think the additional fees come in, but I still don't like fees at that level for a product that effectively you're just buying an existing product in another market. I don't agree with that. But I think if you're looking for a product that's sort of looking at international markets, it might not be a bad option. But like I said, I think you should go and actually have a look and do some more research, because it quite possibly could be something better out there than this one. Hey there, are you interested in learning more about personal finance and investing in the markets? If you are, smash the like and subscribe buttons down the bottom of the screen there. KrackTheSky Value Investing will be giving you up-to-date investing news and content, so you can navigate the markets wherever you are, expand your financial horizon, and crack your financial sky. Hey guys, I hope you enjoyed the video. Please give me a like and subscribe, greatly appreciated. Thank you.